Hello and welcome to MBA 620. This is Project 2, Accounting for Managers. This project has everything to do about accounting concepts with a analytical twist on it. We don't go too deep into making journal entries or anything like that. That's more of financial accounting. In managerial accounting, we've really focused a lot on analyzing financial information. And this course, MBA 620, has to do a lot with analyzing financial information in order for you to make decisions on that financial information. The concept behind this project is to help you to become better financial decision makers based off of the information that's provided to you. So let's start off by reviewing a couple of basic concepts in accounting. And I will also cover basic information on how to read financial statements that are generated by publicly traded companies. So first and foremost, how do we read financial statements, and what is accounting, right? So accounting is the conceptual framework of recording transactions that occur within business. The fundamentals of accounting really has to do with how we record transactions and how are those transactions read. This helps managers make better decisions overall. So there's a lot of information that goes into accounting, but I want to touch on the most basic of concepts. Let's talk about the accounting equation. The accounting equation is assets equals liabilities plus equity. So first, what are assets? Assets are what is owned by a company or by a person. We in business have assets. So assets include things like property, plant, equipment. Cash is an asset. Accounts receivable is an asset. Anything that the business owns or anything that is owed to the business is considered to be an asset. In your personal lives, you also have assets. You might own your house. Your home is considered an asset. You might own your car, your vehicle. Your vehicle is considered an asset. These assets help us to generate revenue or income. In your personal life, your home builds equity over time, which helps you to generate revenue over time. Your vehicle is also an asset, and that helps you to generate revenue over time because you use it to drive to work, right? It's a tool, it's an asset. And it's something that we can sell later in exchange for cash. It's liquidable. These are assets. We have this other thing called liabilities. This is what we owe, what the business owes to other people. In business, we might owe a mortgage. We might owe let me think here, rent. We might owe taxes. We might owe loans that maybe we've taken out. These are all liabilities. Liabilities, anything that you owe to someone else. In your personal lives, you might owe a mortgage payment. You might owe a car payment. You might owe rent or something. These are things that we owe to someone else. Those are liabilities. And then we have equity. Equity is the difference between our assets and our liability. This is what is built up in equity, and equity is essentially the percentage of ownership, right? So if you think of it from your personal lives, with your home builds up equity over time. So if you own your home and you pay down on your mortgage, those mortgage payments eventually turn into equity over time. And the equity that we build up in our home can be utilized as a form of ownership. right? And so that's the concept behind equity. And the same concept applies in business. Equity is the difference between your assets and your liabilities. And these are the fundamentals of accounting. This is also what makes up our balance sheet. And we'll talk a little about our balance sheet here shortly. Kaya asked, can liabilities be services or is it always just money? So wonderful question. So Kaya, to answer your question, liabilities are anything that we owe to someone else in the form of a payment. So that could be for any reason. It could be for a mortgage. It could be we borrowed $20 from our friend, and so we have to pay our friend that $20. That $20 is a liability to us, right? So a liability is anything that we owe to someone else for whatever reason. And that's true in business and in personal life. So wonderful question. And with assets, it's anything that we own. So that could be like our house, our car, anything that we own personally or that the business owns, property, plant, equipment, right? So wonderful questions. So let's talk about the first financial statement in any business that we have. Even before the balance sheet, we have what's called the income statement. The income statement, also sometimes referred to as the earnings statement or profit and loss statement, which is probably what you've most commonly heard. The income statement or profit and loss statement reports profitability for an organization over time. What you need to know most about the income statement is that it records our revenues, our expenses, and our income, net income. Revenues is what's generated from sales of products or services to customers. Revenue is our sales dollars that we've earned, okay? Now, when we record revenue, that could either be from cash sales or credit sales, or it could be from sales that we've made and we've earned, but we haven't been paid yet for. Regardless, that is revenue that we've earned. And that could be in the form of cash, or it could be in the form of credit or whatever. It's sales that we've earned, and that it's also an agreement that we've made for an exchange of goods or services with our customers. So when I sell a good or a service to a customer, I earn revenue from the sale of that good or service. On the income statement, we also have expenses. These are expenses that are incurred from the day-to-day operation of the business. This would include things like rent, payroll expense, utility expenses, office supplies, you name it. Anything that's incurred from the day-to-day operation of the business, these are expenses, and we record these expenses on our income statement during the period of which they have been incurred. And the last thing on our income statement is what we call net income. And net income is a result of what's left over at the end. And how do we get net income? Is we take our revenues, our sales, minus our expenses to get our net income. Now, I will also say that net income can be either negative or positive. When it's positive, that's good. That means we're doing real well. That means our sales are covering our expenses. When it's negative, that means our sales are not covering our expenses. And so instead of it being net income, it would actually be considered to be a net loss. And that's the concept of our income statement. The thing you have to remember is that our income statement include our revenues, which are our sales. The statement also includes our expenses, which are from our day-to-day operations. It also has our net income. There's a couple of other line items that we'll talk about that the income statement has as well that are underneath or in between some of these. And I'll show you that when we look at the workbook. Here's an example snapshot of an income statement. We have our revenue, which are our sales, and we have our day-to-day expenses. We have, from this business, this is a landscaping business, so this is a very, very simple form of an income statement. But the revenue is from the sales that this company made in the form of from mowing the lawns, right? The expenses would include things like repairs, fuel, insurance. These are day-to-day expenses that are generated from our day-to-day operations of the business. Then we have our net income. How we got net income is we took our revenue, in this example is $1,400, minus our total expenses, which is $1,150, to get our net income of $250. So revenue minus your total expenses equals your net income. And this is a very general, very, very basic form of an income statement. I think this is a really good example because it kind of emphasizes what is on an income statement. Now let's look at the next financial statement. We call this the balance sheet. The balance sheet is, the purpose of having a balance sheet is to identify the balances of our assets, liabilities, and equity at any given time in the history of the business. Understanding your balances in business is very, very important. We need to know how much cash we have in the bank, how much our buildings are worth, how much our equipment is worth, how much our land is worth. We also need to understand how much we owe to other people, and we need to understand how much equity the business is building up over time. So on the balance sheet, it shows the company's financial condition at a specific point in time. And so on your balance sheet, you'll find your assets, your liabilities, and your equity. This is the accounting equation. And so on your balance sheet, it will look like this. You'll see that it reads from left to right instead of going top to bottom. We have our assets on the left. We have our liabilities and equity on the right. I want to point out some very important items here. Our assets include things like property, plant, and equipment. In this example, we have our cash and equipment. We can see that our cash and equipment equal $18,700. On the right side, we have our liabilities and our equity. Liabilities, again, is anything that we owe to someone else. This would include things like accounts payable, wages payable, taxes payable, you name it. Any loans you may have taken out, so forth and so on. In this example, our liabilities equal $1,850. And our equity, our capital that we've built up over time, is $16,850. If you add up your liabilities plus your equity, you get to $18,700, which balances or equals our total assets. The accounting equation is always in balance. Your assets will always equal your liabilities plus your equity. So in this example, we see that our $18,700 in total assets equals our liabilities plus equity of $18,700. This is the fundamentals of accounting. The third and otherwise very important financial statement, these are the three most common financial statements. We have our income statement, balance sheet, and now our statement of cash flows. And this third of four primary financial statements is used to evaluate the company's operating performance. This financial statement only takes into consideration the cash that is coming into and out of the business. That's why I call it cash flows. as cash that comes into and out of the business through day-to-day operating activities, investing activities, which include purchase of property, plant, and equipment, or the sale of property, plant, and equipment. And it also takes into consideration any financing activities, which would be taking out a loan, paying back a loan, issuing stocks and bonds. Those type of activities we call those financing activities. And so this financial statement is a snapshot of a company's financial performance based off of their operating, investing, and financing activities in the form of cash flows. Again, cash flows are cash coming into and cash going out of the business on a day-to-day operation, as a result of day-to-day operations, as a result of investing activities through the purchase or sale of property, plant, and equipment, and financing activities such as taking out a loan or paying back a loan, or issuing bonds or paying back bonds, or the issuance of stock, things of that nature. And so here's an example of a statement of cash flows. It's a very detailed report. It shows our our operating activities here at the top. These activities include the payment or receipt of cash as a result of day-to-day operations. We can see all of the various accounts that are impacted by this. The second category here in the middle is for our investing activities. And again, this is a result of the purchase or sale of property, plant, and equipment. And then in our financing activities, this would be things like paying back a loan, or issuing a loan, or stocks or dividends, or anything that involves the financing of a business. And then we see that each category has essentially a starting and end balance. And this represents the cash flow coming into and out of the business during a particular period of time. And that's the concept of a statement of cash flows. So it's very important to get a basic understanding of how to interpret or read these financial reports. And there's a lot of different reasons why this is important. From a business perspective, we need to understand the health of the organization, the financial health of the organization. This also helps the business to make decisions in terms of financing, operating, or making other financial decisions in order to grow the company. The objective, as I said in the previous project, of any business is to make a profit, regardless of whether it is a for-profit or nonprofit. The objective of any business is to indeed make a profit. And in order to help managers make decisions on what they need to do to increase their overall profit earning potential, they need to understand how to interpret their financial reports to best make decisions. When it comes to publicly traded companies, we can find information, financial information on any publicly traded company by visiting the Securities and Exchange Commission website. The Securities Exchange Commission, or SEC, is a federal regulatory agency that regulates corporations with respect to their shares and with respect to their periodic financial filings. And we're going to talk a little bit more about that here in the very near future when we look at the workbook. So let's do that. Let's take a look at the workbook, and then we'll jump into horizontal analysis. So when you go to your classroom and you visit projects, and you come on down to project 2, accounting for managers, and have to read through this lovely stuff and watch this fun little video we created, come down to step 1. Now with step 1, a couple of key points I do want to touch on. We have some learning links to the income statement, balance sheet, statement of cash flows. They're good. They're okay. They're not the greatest learning topic pages, but they're not bad. I would recommend that you just take a glance at them, just get a little bit more information on what each one looks like and what's going on in each financial statement. And then come on down to the bottom and definitely click on this one, the horizontal analysis link. That one will be very, very helpful when it comes to completing a couple of parts of the workbook. But go ahead and download your workbook. Go ahead and click on your workbook and open it up. And when you open it up, it should look like this. You'll see that there's 1, 2, 3, 4, 5, 6 tabs total. The first tab is the instructions. And you need to read through these instructions to understand what you need to do to complete the project. So it says the first thing I need to do is go to the Securities Exchange Commission website because I need to find information on the company. The company for this project, as you know, is Choice Hotels. So what I'm going to do is I'm going to come to my web browser. I'm going to go to sec.gov. And I'm going to come up here to the top right. The first thing you want to do here is click on this little link that says Company Filings. So go ahead and click on that Company Filings link. And the quickest way to find information on the company, instead of typing out the company name and then going through a list of company names, it's very quick and easy to go to this fast search option. And the ticker symbol for Choice Hotels is CHH. So go ahead and enter CHH and click search. And verify up here, it'll say Choice Hotels International. That's the company we're working with. And one thing you'll notice is Choice Hotels is a local Maryland company. All of the companies that we work with in this course are Maryland-based companies, with the exception of the first one, which was ExxonMobil. They are not native to Maryland, but they do have a large presence in Maryland, which is the reason why we selected them for Project 1. For Projects 2 and 3, we're working with Maryland, well, 2, 3, 4, and 5, we're working with Maryland-based companies. And Choice Hotels is located in Rockville, Maryland. Now, if you're looking at the project directions, what we're looking for here is the 10K report. How do I find the 10K report? Well, there's a couple ways you can do it. You can either go up to Filing, type the word 10K to sort out all the data below, or you can just scroll on down here and you'll see that it's right here. It's the seventh one down. It says 10K. And there's two parts of the information that you could look at. There's documents and there's interactive data. You want to select the one that says documents. And the documents will open up. There's a bunch of exhibits. We're not too concerned about those. We are only concerned about the whole 10K report. So you'll see here that item number 1 is 10K. Go ahead and select on that first link under document for 10K. And it'll load up the 10K report. Now this document is 100 and some odd pages long. I forget how long it is, but it's 100 some odd pages. Please, I don't print that. That's a lot of printing. So don't print that. That's a lot of bedtime material, right? So I would not advise you to print that out. But the reason why we want to open this up is because we want to familiarize ourselves with the company that we are working with. So this is Choice Hotels. And I do this for pretty much every business that I ever invest in or am interested in learning more about. You can do this for companies that you're interested in working for that are publicly traded to understand what the company's current situation is. You can do this for companies that you're looking to invest in or whatever. The nice thing is they're all publicly traded, so their information's here. You will not find privately held companies on SEC's website, but you will find the publicly traded ones. And so anyway, the reason why we have this exercise is we need to learn more about our new client, Choice Hotels. And so to do that, you'll read through the SEC's 10K report on Choice Hotels. So going back to our workbook, the first first tab that we have here is 10K document questions. Now, to answer these questions, you want to look at both the 2019 and 2018 10K reports to help best to answer the questions. The reason why we have these very short 5 questions here is to help you to familiarize yourself with the company. The first question is, what is their business model? Well, we can find out what their business model is by reading the 10K report. And typically within the first few pages of the 10K report, you'll find out exactly what type of business this is. What is their business model? And especially if you see here under item 1, business, it tells you exactly what kind of business model that they're operating. And if you look right here, it even tells you what kind of business this is. We can tell that it's mostly a franchise model. It's 97% franchise, which is interesting because in previous years, they used to be 100% franchised, but now they're 97% franchised, which means they're getting into the business of owning their own hotels, which is really fascinating. Another great thing you'll find with these 10K reports is it talks a lot about, a lot of these are forward-looking. It means what does the company look like going forward? What are their objectives going forward? Very interesting stuff. And so the basic principles of these 10K reports is to help you to identify what the company does, what the company is all about. So that'll help you it'll help you to answer these 5 questions. What have they done historically with respect to their shareholders? This one's a good question. The company has grown over $1 billion in managed assets in 2018. It's a really big number, as you might expect. So, and it says, how much did the company pay out in dividends in 2012? Dividends are really interesting. For those of you who don't know what dividends are, these are regular payments that the company makes to their shareholders. For being shareholders, a shareholder is somebody who invests in the company by purchasing a share or a piece of ownership in that company. And some companies reward their shareholders with dividend payments for being a part owner of the company. And anyone can own a publicly traded company. I personally have a couple of shares in a few companies like Starbucks. And my shares sometimes earn dividends depending on how well the company does that year. And it depends if the company decides to pay dividends during that year. And so this report will help you to answer the questions. So that'll be the first part of the project, is answer the questions. And then after you have done that, you'll come over to your income statement, balance sheet, statement of cash flows. Now, on the income statement, as I said before, income statements have revenues, expenses, and eventually your net income. We can see that there's a lot of detailed information here. And the income statement has data from 2019, which was last year, 2018, and 2017. And the purpose of having this information is to conduct what we call a horizontal analysis. A horizontal analysis, going back to the slideshow presentation, a horizontal analysis is a trend analysis. And we use this trend analysis to compare information from year to year. These trends tell us the percent changes in each category year over year to help us to make decisions based off of these changes. And to compute these changes, we do it in both dollars and percentage. With dollars, it's just simply taking the new amount minus the old amount. And to get the percent change, we take the new amount minus the old amount divided by the old amount. Now, point of caution, we see here the order of operations. I'm sure you all remember that from grade school. Order of operations tells us anytime that there are parentheses like this, we do that first before we do the division. So new minus old, we do that first to get our what is that, numerator? And we divide that by the denominator. So let's go back to our workbook. So I'll help you to walk you through the first one. And it tells you up here at the top, it reminds you even of the formula. So we see here the first part we want to figure out is the dollar change from 2019 to 2018. So we go, and please use Excel for all of this. It will help to save you time, and it will also prevent any errors from occurring. So to get the dollar change 2019, 2018, we go equals the 2019 dollar amount minus the 2018 dollar amount and hit enter. Then to get the percent change 2019, 2018, we go equals open parenthesis 2019 minus 2018 close parenthesis divided by 2018. And that gives us the percent change from 2019 and 2018 for royalty fees. Now we want to do the same thing from 18 to 17 equals 2018 minus 2017 to get our dollar change. And then we want to get the percent change from 18 to 17. So we go equals open parenthesis 2018 minus 2017 close parenthesis divided by 2017 to get the percentage. And it really is that simple. Now I'm going to show you a wonderful trick in Excel to save you a ton of time from having to do that over and over and over and over again. So let me show you a very nice, easy trick, which I'm sure probably most of you already know about. So what we do is we highlight these cells, and you're going to see this little notch that appears here in the bottom right corner. Now, a very nice shortcut to enter all that data in is to go like this. We hover your mouse over that little notch that appears in the corner. Your mouse will turn into a little plus sign. As soon as it does, click your left mouse button and drag on down to the bottom. Now what we noticed is all the data has been entered. Clearly it's not all accurate because there's some areas where there is no data. So just go ahead and clear those cells out. You know, clean it up nice. Okay. Now I can hear you already. You're saying, Dr. B, what about these ones that say hashtag div divided by 0 exclamation? Well, the reason why that error message is occurring is because you can't divide by 0. So when you do divide by 0, the answer is 0. So simply replace that hashtag div divided by 0 with a simple 0. Just enter 0 in. Again, the reason why that happens is because you can't divide by 0. The answer is 0. And Excel will generate an error when something like that happens. So just simply enter 0 everywhere that happens. And now it's accurate. So, and then you want to do the same exact concept for the income statement the balance sheet. You don't need to do that for a statement of cash flows. Now, after you've done that, you want to come down and answer a couple of questions for each of the financial statements. And I will also give you a nice little hint as you're answering each question. And you'll notice a lot of these are open-ended questions, so you want to be analytical in your approach. You'll be able to identify the trends based off of what you've performed here with your horizontal analysis. Now, clearly, there are some significant trends here. The significant ones are where you see larger dollar and percent changes. These are what I would consider to be significant. Now, you'll come down here and you'll answer the questions. A lot of these are based off of significant changes. And there's a couple of questions. A lot of them are open-ended. What I strongly recommend that you do is, as you answer the questions, you want to go back to your 10K report, and you'll be able to find additional information on those changes as you read through the data, as you read through the information. Now, we're on the income statement, so you can find a lot of these items that are significant when you get down to the income statement on your 10K report, which is somewhere down here. It's a very long report, as I said, so I do not encourage anyone to print this. This is a lot of bedtime reading material. But when you get down to your income statement, which is way, way down here, we're getting there, I promise. It's somewhere. Okay, we're getting close. We're getting warm. Okay, here we go. Here's our income statement. Yay, wonderful. Page 41, thereabouts. Okay, you'll notice that these areas, these very interesting concepts are discussed. There's usually notes included, is what I'm saying. And so when you answer your questions in your income on each financial statement, you want to support those your answers to each question with data from your income statement, from your 10K report. So as you're answering these questions, answer the questions with both this data up here and data from your 10K reports to support your statements. Hopefully that makes sense. The point is that you're being analytical in your approach, right? You definitely want to be as analytical as possible and to support your statements with data. And so you'll do that same approach for the income statement, the balance sheet, and there'll be some questions for the balance sheet as well. And there will be questions for the statement of cash flows. Now on the balance sheet, there's a question here that is mathematics. You need to answer with some math. So question 3, this is a math question. The question says, part C of this question. Part C of this question is, what would have been the total shareholders' equity if there were no purchases of treasury stock? Hint, this is a calculation. So in that calculation, you'll come up to your balance sheet for 2019, and we see the treasury stock purchase here. So the question was, what would be the shareholders' equity if there were no purchase of treasury stock? So to answer this question, we're going to take this information here for your shareholders' equity and simply remove the treasury stock amount to be able to answer question 3. So I wanted to point that out because question 3 on the balance sheet is a pain point for a lot of students. So I wanted to make sure that you were aware that that is a math question as well, in addition to parts A and B. Okay, so let's go back to our PowerPoint presentation and let's continue. So here's a nice little example of the horizontal analysis. Very similar to our workbook. We're looking at dollar change and percent change for each line item. And again, the reason why we do this is to identify trends in order for us as managers to make better decisions based on those changes over time. So that's step one of the project. And step one covers the 10K questions, the income statement, balance sheet, and the statement of cash flows. And again, as you're answering these questions, support your responses with information from the 10K report as well. Now let's jump into our ratios. Yay, ratios. I know you're all so very excited. Okay, so step two of our project has to do with ratios. Now, the reason why we calculate ratios in business is to get a better understanding, a quick understanding of the financial health of the company. These ratios tell us how well a company is operating, how profitable they are, how well they're managing their debt, how liquid the business is. These are really, really important calculations for us as managers to make in order to understand the financial health of the company. So ratios are very important evaluation tools for managers to understand the overall health of the company. These ratios are interpreted and benchmarked against the industry that the company belongs to understand how well the organization is performing in comparison to their competitors. And now, here are a couple of key ratios that we'd like to discuss. The first is liquidity ratios. This tells us how a couple of things. It has to do with the working capital. Working capital is the amount of money that the company has after it has met its short-term obligations in order to use that working capital to reinvest into the company or to repurchase stock, or it's working capital. It means the funds that the company has in order to work with, right? So it measures the ability of the company's business to meet its short-term obligations, and these are associated with working capital. Those are liquidity ratios. We also have debt management ratios. This tells us how effective the company is with respect to paying off their debt. Is the company able to meet its short-term and long-term liabilities? And so we can use debt management ratios to determine if the company is able to be solvent. Solvency is the company's ability to satisfy all of its obligations and therefore being solvent. Solvency is also determined in the event of bankruptcy. If the company has the ability to pay off all of its debt, we consider it to be solvent. Insolvency is where the company is not able to do so. And this is the case for a couple of companies currently and companies even before this crisis. Examples of companies that are insolvent would be Sears, Kmart, Macy's, JCPenney, the list goes on, right? These are companies that are insolvent. They cannot satisfy all of their liabilities. And therefore, when they do go out of business, not all of their debtors will be repaid. And so we as investors run things like the debt management ratio before investing into a company in order to determine the company's overall financial health. We also look at things like profitability ratios. This tells us the company's ability to generate a profit, which is very important when it comes to investing in a company. We want to invest in healthy companies, ones that we know will be around, and ones that we know can generate a profit, because we as investors like profit. And then, of course, the market value ratios. These tell us the overall value of the company. What is the company worth, right? And so by calculating market value ratios, we can tell the company's overall value, how much the company is worth. And so there are a couple of ratio calculations that we'll make in this project to tell us about Choice Hotels' overall financial health. We're going to calculate the current ratio. The current ratio tells us if the company has the ability to satisfy its current liabilities using its current assets. Now, the word current means within the most recent 12 months. In finance and accounting, we have what's called current and long-term. Current means 12 months or less. Long-term means 12 months or more, right? So 0 to 12 months is current. Greater than 12 months is long-term. Now, the current ratio tells us the company's ability to satisfy its current obligations. And this ratio is very important to tell us how healthy the company is in the current term. And so the higher the current ratio, the more likely the company can cover its short-term obligations or short-term debts. And so that calculation is we take our current assets and divide that by our current liabilities. The current assets and current liabilities can be found on the balance sheet, Assets and liabilities are on the balance sheet. We can find current assets and current liability line items on the balance sheet. Another calculation that we'll perform in this project are the market debt ratio. And in this, we're looking at the solvency that measures the portion of book value to the company's debt, the sum of the book value of the debt, the market value of equity. Oh my, those are a lot of words. In the short run, this tells us, is the company solvent or not? Okay, and so this calculation, for the market debt, we take the total debt of the company, we divide that by the total debt plus the market value of equity. Don't worry, we'll provide that information to you. The total debt you'll be able to find on the balance sheet, especially under the liabilities section. Two more ratios we'll be calculating in this project. The first one is the net profit margin. This is the percentage to each sales dollar that remains after all expenses have been paid. Net profit margin is a wonderful way to tell if a company is generating a profit on a period-by-period basis, month-to-month, quarter-to-quarter, year-to-year. This tells us the company's ability to generate a profit within a specified period. The calculation for this is we take our net income, which is found on our income statement, and divide it by sales or revenue, which is found on our income statement. We multiply that by 100 to get the percent, to essentially turn it into a percentage, right? And that tells us our net profit margin. And the other ratio here is what we call earnings power. And this shows us the company's ability to generate a profit from conducting day-to-day operations. It's used to analyze stocks to assess whether the underlying company is worth an investment. And so to calculate earnings power, we take our earnings before interest and taxes, or also known as EBIT, that is earnings before interest and taxes. And that line item can be found on our balance sheet. On our income statement. Earnings before interest and taxes is found on our income statement. And we divide that by the total assets, which is found on our balance sheet. So earnings before interest and taxes found on our income statement divided by total assets, which is found on our balance sheet. And the final ratio calculated here is our days sales outstanding. This is a measure of how many days on average it takes for the company to collect a payment that's owed to the company after a sale has been made. And so to calculate this, we take our accounts receivable and we divide that by our average sales per day. To get our average sales per day, we take our annual sales and we divide that by 365. And to find our annual sales, we look at our income statement at the top. That's our revenue. Our total annual revenue is our annual sales. We divide that by 365 days to get our average sales per day. And so we take our accounts receivable, which is found on our balance sheet under current assets, divide that by our average sales per day, which are calculated by taking our annual revenue, which is found on our income statement, divided by 365 days. And that'll get you your days of sales outstanding. Now, going back to our workbook, we come to our last tab on our workbook, which is our ratio analysis tab. And we can see here that we have to plug in some data. We've tried to make this as simple as possible for you. So what you'll do is you'll go to each respective tab and plug it in. So for example, the first question has to do with the calculation of current liabilities. We have 2019 and 2018. Current assets and current liabilities. Current assets divided by current liabilities gives us our current ratio. So what we do is, and please, again, do not hand jam anything into Excel because there's a risk that you may make an error. So the best way to do this is to go equals, then select our balance sheet, find your current assets for 2019, total current assets, 2019, select that cell, and then click, then hit your enter key, and we see it transfers over to this tab. Now you want to do the same thing for your current liability, so equals, click your balance sheet tab, select your current liabilities for 2019, click enter, and then to calculate your current ratio, you go equals current assets divided by current liabilities, enter, and there is your current ratio for 2019. You want to do the same exact thing for 2018. And the same concepts apply for the rest of these ratios. So it's just a matter of plugging the respective amounts in. So your debt ratio, you'll be able to find that information on your balance sheet. Your net profit margin, as you know, that you'll be able to find that on your income statements. So for example, net income, we go equals, select your income statement tab, 2019 net income, which is right here, enter. Total revenues equals income statement, total revenue, 2019, enter. And as you know, the net profit margin is equals net income divided by total revenue. There we go. Now you can either do times 100, or the most simplest way to convert this into a percentage is to simply come up here on your ribbon and click the percent button, and it turns it into a percentage. We want to do the same thing for 2018. And then for your basic earnings power calculations, EBIT, earnings before interest and taxes, for 2019, we go equals income statement, come down toward the bottom, you'll find your, where are we? Earnings before, earnings before interest and taxes, or is also known as, where are we? Where's our interest income? There we go. So you'll see here, you have our interest and we have our taxes. All of this is under. So your true earnings before interest and taxes is going to be what we call your operating income. So use operating income for your earnings before interest and taxes. Go ahead and click enter. And your total assets is found on your balance sheet. So go equals balance sheet, total assets 2019, enter. Earnings before interest and taxes equals EBIT divided by total assets. There's your EBIT, just convert that to a percentage. And so forth and so on. And you'll do the same thing for 2018. Now, question 5 are receivables. So for 2019, we go equals, receivables is found on your balance sheet under your current assets. So total receivables. Here are your receivables. It's the second line item. Go ahead and click enter. Your revenue. Revenue, as you know, is found on your income statement. So go equals income statement, total revenue 2019. Okay. 365 days, we go 365. Get your average sales per day. So as you know, your average sales per day, we take our revenue, total revenue, and we divide that by our 365 days to get our average sales per day. And to calculate your days sales outstanding, as we said in our PowerPoint slide, we take our accounts receivable divided by our average sales per day. So we go to average, so we go equals receivables divided by average sales per day. There you have it. And you'll do the same thing for 2018. Then question 6 is explain the significance of your ratio calculations. So in other words, for question 6, it's a very open-ended question. The question is simply saying, why are we doing this? What is the significance behind calculating these ratios? And what does it mean? So we see here that on column L, we have our suggested level for good result. These are our industry averages. And so we can see that based off of our industry averages, Choice Hotel is doing quite well. It's above 0.42 for the solvency ratio, the current ratio. For our net profit margin, above 8%, we're at 20%, so we can see it's doing better than the average. Above 12% for earnings, basic earnings powers, we're at 23%, so that's really good. 50 days or less, it's okay for the received days sales outstanding. It's close to 50 days. It'd be nicer if this number was a little bit lower. So in question 6, it's very open-ended. We want to explain the significance for these ratio calculations. And so to do that, you want to basically take what we've learned up here from calculating these ratios and explain why they're significant. And they'll help you to answer question 6. And if you use any type of outside information, please make sure that you use citations. And also, please make sure you use spell check. In order to do that, you just click on your review tab and then click the ABC check spelling, right? And that is the end of the workbook. So that will be your work for this week through Tuesday night. Then in the following week, we will have a discussion. Ethics is a major topic of discussion in accounting and finance, as you might expect. It's very important that businesses are transparent, open, and honest with all of their stakeholders. Stakeholders, as you know, is anyone who's at all has a stake in the company. This would be the government, this would be employees, investors, environmental relations, so forth and so on. There are a lot of standards that govern the overall reporting of publicly held companies. In the United States, the governing bodies are the Financial Accounting Standards Board, which utilizes generally accepted accounting principles in the reporting standards. And the reason why this is important is because these help to standardize the reporting in order to protect stakeholders. There's a lot of principles that are involved in generally accepted accounting principles. We're not going to go through all of these, but I do want to make you aware of these principles because these help to govern all of financial reporting in accounting. Internationally, there's the International Accounting Standards Board for multinational corporations. A lot of countries utilize IASB as their reporting standards. And recently, there is a convergence happening between the Financial Accounting Standards Board and the International Accounting Standards Board in order to create a worldwide standard for financial reporting. And of course, the reason for this is for standardization and to protect stakeholders when it comes to investing in companies. 2002 was a big year for the protection of investors through the Sarbanes-Oxley Act. This was a way to help prevent fraud from happening in corporations by mandating that publicly traded companies are audited by an independent accounting firm, regulator. And so the reason why this came about is because of a lot of fraud that was happening prior to 2002. There were a lot of companies that were engaging in fraudulent activities, most notably here in the United States, Enron, which was an energy company in the southern states, was committing a large fraud at that time by inflating their books. And so the government stepped in to help regulate that type of thing from happening to protect investors, because a lot of investors lost millions and millions of dollars from these fraudulent activities. And as a result, the board of directors and a couple of high-level people were fined and also went to prison for committing fraud. And unfortunately, the investors never saw their money back. And so the government helped to step in to protect our investors. So in that discussion, we will be looking at events that have happened in the past, and we'll discuss how our government is helping to protect investors. The idea is to discuss ethics. What is ethical? What is not ethical? And so that'll be the discussion forum. And then, of course, last but not least, as always, you'll have an executive summary. Very similar to the executive summaries that you developed for Project One. Most of you did a wonderful job in developing your executive summaries. You want to make sure you include these basic principles, purpose, problem, methods of analyzing the problem, results of analysis, and recommendations. Please make sure that you are being very analytical, be very specific, and include as much, I can't emphasize this part enough, please make sure that you include a lot of quantitative detail from your project when you craft your executive summaries. This helps to support the claims that you're making. You want to write this like you're writing it for the executive board at Choice Hotels. As you know, executive summaries are read by top-level management, and they take this very seriously. The purpose of why we're doing this is to help Choice Hotels look at their trends over time and to help provide them with some guidance. the company's looking to grow, so that might be a part of the problem. Read through the 10K report to help you with this. Those first few pages of the 10K report show you the direction the hotel company is heading in. So that will help you to identify the purpose and the problem that the company is looking to solve. The methods that you're using to analyze a problem, of course, are going to be your horizontal analysis that you're identifying through the workbook. You're also utilizing ratios in that process. So use the data that you're identifying in your trends as a part of your methods. The results of your analysis should also include data from the workbook. And you also want to analyze those results supported by information from the 10K report. And then make your final recommendations to the company. These are ways you can help to grow the company or to stabilize the company or whatever it is that they're looking to do through your recommendations, and support that information, of course, with data from the workbook and as well as 10K information and anything else you might find relevant for the company. And that is the conclusion of Project 2. Are there any comments, questions, or concerns I can help to answer by those of you who are on the call for Project 2? Hopefully this was helpful. Any comments, questions, or concerns at all? Again, you're all on mute, so if you do have a question, please unmute yourself. It was helpful? Kaya says it was good. Giselle says it was good. Lauren, any question? Good? Great.
No questions here.
Wonderful. Thank you so much.
Thank you. Thank you for your time tonight. I appreciate it.
Oh, thank you for your time. I really appreciate you all being here. This is great. I really enjoy these types of sessions, and I do hope that they're helpful. So, okay. So in that case, let's call it a day. And if you have any comments, questions, or concerns in the meanwhile, please feel free to email me. You know that I'm very responsive. I typically get back to you as quick as I humanly can. And in the meanwhile, I hope that you all stay safe and enjoy your time. And I hope that you all have a wonderful rest of your day or evening, wherever you may be in the world. And I'm here for you. So if you need anything, please let me know. Thank you all so very much. Have a wonderful, wonderful rest of your time.